In this video, we will discuss what order flow is and how to use it for a deeper understanding of market context and making more informed trading decisions. Essentially, this is a continuation of the previous part about dealing range. If you haven't watched it yet, the link is in the description. Often, order flow in trading refers to the analysis of buyer and seller actions using various tools such as tape reading, order book, or vertical volumes. All of this is valid and can help traders better understand key support and resistance levels, assess the authenticity of price movements, and so on. But we are gathered here to look at all this differently, namely, through the lens of volume and variables that the market provides us. This schematic diagram shows an upward movement, where higher highs and higher lows are forming. In basic interpretation, this indicates buyer strength, that is, a bullish trend. But if we look deeper and try to understand why this is happening, we'll see that the price first interacts with a zone of interest in the form of liquidity or inefficiency, from which it receives buying volume. Due to buyer pressure, we observe movement towards the first trouble area, in the context of which selling volume already enters the market. A so-called corrective movement forms to some new zones of interest within this range until the price again receives dominant buying volume and the movement continues to the next trouble area. This process can repeat for a very long time, but the principle remains simple. We always have a certain sequence in the form of a zone of interest, price delivery, and trouble area. And all of this is additionally accompanied by the formation of new dealing ranges. From the previous video, we already know that the dealing range is divided into two main zones: the premium zone, optimal for selling during downward movement, and the discount zone, optimal for buying during upward movement. But in addition to this, there is another important concept called the premium discount array. These are levels within the dealing range that help more accurately determine where the price is more likely to receive a reaction. Essentially, these are the same zones of interest, often in the form of order blocks, fair value gaps, or sometimes rejection blocks at the beginning of a movement, provided they are large enough. Similarly, these can also be fractal points within the range, often referred to as inducement in the trading community. This concept may raise some questions, so let's pause here to explore it in more detail. Inducement in this context implies that during retracement, the price will interact with liquidity beyond the fractal points, after which it is more likely to receive a reaction and reverse in the opposite direction. Otherwise, this element would not have logical sense and effectiveness, as it is often used for opening positions directly from the fractal point. But similarly, traders who trade market structure first wait for a liquidity raid, followed by a structure break, from where they then enter positions. Therefore, by analogy in our strategy, we designate inducement only when we want to see or have already seen volume confirmation in the context of a liquidity raid beyond the fractal. Everything else that can potentially provide liquidity to the market can be called liquidity injection, and this will be quite simple and understandable. Order flow in the smart money concept. Smart money differs in its understanding of order flow, as it is closely related to large players and manipulations stemming from their capital. Schematically, it looks something like this. Price regularly conducts liquidity raids, forms false structure breaks, but ultimately moves in the initial direction. That is, the main focus is on periodically taking liquidity from one side, which many perceive as deception, attributing it to algorithms from Rothschild's laptop and world government conspiracies. I am by no means claiming that market manipulations do not exist, because the very logic of order block formation is related to this. However, I want to draw your attention to one very interesting detail. When there is a unidirectional movement from one point to another in the market, the price on smaller timeframes, let's say hourly, may produce certain fluctuations that look like dealing ranges. Traders enter trades from these ranges to continue the movement. At the same time, on the 4-hour chart, the price is delivered from one zone of interest to another, forming one full-fledged dealing range. Within the trouble area, the price receives a corresponding reaction, which leads to a deeper test within the range. On the hourly chart, this may look like a complete invalidation of some trading ranges. Let's consider an example. On the 4-hour chart, the price removes liquidity by a few points from the fractal low, after which it aggressively forms a high-resistance dealing range. In the context of the trouble area, namely a bearish fair value gap, there is a pullback to the nearest zone of interest. However, It doesn't receive enough buying volume, and the movement cannot continue, so the price makes another, deeper entry into the discount market zone, where it tests a similar FVG zone. Only after this does expansion occur. If we look at the price action on the hourly time frame, we will immediately notice two smaller dealing ranges. They are even high resistance according to our classification, where the minimum of the second acts as inducement within the entire trading range on the 4-hour chart. Note that the price on the same time frame confirmed volume in the form of a rejection block after the liquidity raid, but at the same time on a time frame lower than the fair value gap on the 4-hour chart. Take note of this fact. Another manifestation is when the price forms fractal points within the range on the same time frame. We can display this using regular candles. Let's say, in the context of a zone of interest, the price receives buying volume and delivery begins in an upward direction. At the same time, there may be minor levels along the way or even a decrease in market volatility, which can lead to the formation of such fractal points inside. And when the price finally arrives at a significant trouble area, it can receive a strong enough reaction, which will lead to a correction to the zone of interest, which will be this fractal. That is, the rule from zone to zone is applied again. Also, here we can say that the price moves from internal liquidity to external and from external liquidity to internal. I hope I managed to convey my idea, but for a better understanding, let's look at a real example. On the 4-hour chart, we observe a liquidity raid from the fractal high, followed by volume confirmation in the form of an order block zone. The price is delivered quite aggressively to the trouble area, which was able to provide enough liquidity to the market to form a fractal low, defining the range boundaries. Since this fractal low, which previously took out liquidity, is a place where the balance between sellers and buyers changed, there is a slight resistance on the second approach, which formed a fractal high in the premium zone. Further, we observe a liquidity raid and price delivery continuing in the direction. A similar example on the weekly time frame, but here the price couldn't reach the fractal low, and eventually the entire trading range was broken through. But this can look different if we don't consider every fractal point, which in essence is not necessary to do. Pay attention to key levels, especially on smaller time frames, where price fluctuations occur quite frequently. To move forward, we need to understand another very important principle that I discovered while reviewing various materials on the internet. This is the principle of buyer and seller aggression, which correlates in a special way with the logic of trading ranges and order flow. At its core, buyer aggressiveness is expressed in their willingness to absorb seller volume at higher prices without waiting for corrective movements. Seller aggressiveness, in turn, is the willingness to absorb buyer volume at lower prices, also without waiting for corrections. Accordingly, buyers are willing to buy in the premium zone, while sellers are willing to sell in the discount zone. This is a very important detail. Schematically, this manifests in a movement where the price, in the context of a trouble area, makes a small retracement to the nearest inefficiency zone, often in the form of a fair value gap within the range, and continues its movement, which is called aggressive order flow. There are cases when the price can enter short consolidations, which many refer to as rally-based rally, for a bullish scenario, and drop-based drop for a bearish one. Often with this type of aggressive movement, minimum and maximum points are not even formed. Let's look at a few more examples with real charts to form a complete picture in our minds. This is the GBP-USD pair, and on the 4-hour chart we see the formation of a bearish dealing range. In the discount market, there is an inefficiency zone in the form of a fair value gap, from which the price receives a reaction and forms a new dealing range. The principle is exactly the same. The price essentially reacts to the nearest inefficiency zone. However, to be fair, it should be noted that it doesn't receive an aggressive reaction. Nevertheless, the logic holds, even if the price remains in a small consolidation for some time. This is now the euro on a 5-minute time frame. The example here is very interesting. In the context of this upward movement, we observe how the price forms dealing ranges and doesn't even have the strength to correct more deeply. It essentially consolidates in place because buyers are exerting great pressure. A similar example with the euro on the daily time frame. We see that the price reacts to the nearest zone of interest. This is also observed with the British pound on the 4-hour chart. If we summarize and give a general definition of what order flow is, we get approximately the following formulation. Order flow is the price delivery from one point to another, which is expressed by the active formation of inefficiency and liquidity zones due to buyer or seller pressure. These zones subsequently act as catalysts for the formation of new dealing ranges and the continuation of the trend movement. A more precise definition is that order flow is divided into two types: regular and aggressive. Regular order flow is characterized by the price reaction to any inefficiency or liquidity zone within the range, which we also call the premium discount array. The main thing is that the price does not reach the extreme that would invalidate the idea of the entire dealing range. Aggressive order flow is when the price reacts specifically to the nearest zone of interest in the premium zone in a bullish scenario and in the discount zone in a bearish scenario, after which it continues its movement. An exception may sometimes be touching the 0.5 level, which is considered as equilibrium. Accordingly, when the price cannot continue its movement, or even breaks through and consolidates beyond the nearest zone of interest, we consider that aggressive order flow is no longer relevant, and we look at the reaction from other elements according to the principle of regular order flow. Order flow invalidation is an integral part of market advantage because you will be able to predict when you should refrain from opening positions, and vice versa. The first basic indicator, which I talk about throughout this video, is that order flow is the same as dealing range, expressed on a different scale and vice versa. It all depends on the time frame from which you look at the market. Let's consider a hypothetical scenario for better understanding. Imagine that on the daily chart, the last dealing range has formed, which has reached a trouble area on the weekly time frame. In such a situation, there is a high probability that this daily range will be invalidated. The reason for this phenomenon lies in the fact that the price will likely tend to correct to a certain zone of interest, but already in the context of the weekly time frame and dealing range. It's important to note that this doesn't happen instantly and can take some time. Such price behavior demonstrates the importance of considering various timescales when analyzing market movements and emphasizes the relationship between dealing ranges on different timeframes. The second indicator is especially applicable to situations where the price, in the context of a trouble area, confirms its readiness for a reversal. The formula looks as follows. Variable 1. Trouble area is equal to or greater than variable 2, volume confirmation. If this occurs, we can expect a deeper correction or complete invalidation of the dealing range, especially when it doesn't contain liquidity or inefficiency zones and is not high resistance. This weekly dealing range has inefficiency inside, but nevertheless, if we look at the daily time frame to see what happened within this fractal, we can easily discover that the price confirmed volume in the form of an order block zone. And a corrective movement began, ignoring the nearest inefficiency zone. The key point is that we always strive to work from the nearest zone of interest within the framework of aggressive order flow. Let's consider an example. On a 4-hour chart, there is a trouble area and the nearest zone of interest. If the price, in the context of the trouble area, confirms volume, let's say on the hourly chart, then reaches the zone of interest and continues its movement, our formula loses relevance and can be ignored. However, if after volume confirmation the price breaks through the nearest zone of interest and consolidates beyond it, aggressive order flow loses its relevance. In this case, we switch to the principle of regular order flow within the entire dealing range and expect the price to react to other inefficiency or liquidity zones, above or below depending on the direction of movement. This same logic applies even in cases where the price does not confirm volume in the context of the trouble area. It's crucial to grasp and consider this subtle yet important point. Here, it's necessary to make an important addition. The zone of interest within the range doesn't necessarily have to be on the same time frame as the trouble area. This is especially relevant in the context of aggressive order flow. You can observe the price reaction from the zone of interest on a lower time frame as well. For example, if the price reaches a trouble area on a 4-hour chart and then enters the nearest zone of interest on an hourly chart, which it cannot break through, or from which it reverses, this can also be considered as aggressive order flow. I recognize this may sound complex, but it's crucial to understand. The essence lies in the relationship between the trouble area and the zone of interest within the dealing range. These 3 schematic drawings can help you with this. You may have a question: how to determine if the price is ready to continue its movement from the nearest or any other zone of interest within the dealing range and order flow? The answer, as always, is simple. You need to wait for the test of the zone of interest and confirm the volume, on the same time frame or lower. This is what you will base your further decisions on. Now we move on to the final part, where we will discuss the basic methods of using order flow. All positions will be opened according to the logic of the updated combo algorithm, which we will discuss in detail in the next video. I want to note that sponsors of this channel, as a token of gratitude from me, will have access to the video sometime earlier than everyone else. So if you want to be among the first, welcome. If we illustrate schematically where order flow begins, it's usually a zone of interest, for example, on the weekly time frame. In the context of this zone, the price confirms volume on the daily time frame and may form a certain dealing range. In our example, a similar situation occurs. After rebalancing the weekly fair value gap, the price removes liquidity from the weekly fractal high. On the daily time frame, 3 inefficiencies, 1 order block, and 2 fair value gaps are formed. Any of these zones can serve as a zone of interest, in the context of which we will look for positions to continue the movement within the high resistance dealing range. For a more detailed analysis, we need to switch to the 4-hour chart. Here we see that the price impulsively breaks through the first zone of interest, but in the context of the second FVG, as well as the order block on the daily time frame, it confirms volume on the 4-hour chart in the form of another FVG. On the hourly chart, we observe an additional liquidity injection in the form of a fractal point. Accordingly, we can place our order right here. We set the stop loss behind the 4-hour fractal maximum as the invalidation point for this idea. Since our initial zone from which we are working is the daily bearish fair value gap, the target will also be on the daily time frame, namely the fractal minimum. As a result, we got this combination. Variable 1, volume confirmation greater than variable 2, volume confirmation greater than variable 3, liquidity injection, from where the position entry was made. The execution didn't take long, and the position closed the next day with a risk-to-reward ratio of 2.62. We move to the daily time frame again and see a new high-resistance dealing range with an order block in the premium zone. On the 4-hour chart within the daily order block, there is a fractal high as a potential inducement, from which we want to see volume confirmation. On the hourly chart, the price confirms volume by forming a rejection block, which closes with the second candle below the fractal level, which can generally be used because the rejection zone itself is the entire black candle. We also observe the formation of a dealing range according to the second formula, with a fractal point inside the discount zone. This position will be slightly risky, but we can still open it within our logic for this combination. Variable 1, volume confirmation greater than variable 2, inducement greater than variable 3, volume confirmation greater than variable 4, liquidity injection. We set the stop loss behind the fractal maximum and the take profit at the nearest daily trouble area, which is the fractal minimum. The price takes our order quite impulsively, but ultimately it starts moving in our direction. At the same time, an order block zone is forming on the 4-hour chart, which is a full-fledged volume confirmation on a time frame below the daily order block. From here, we can also enter a position if the risk-to-reward ratio is optimal for us. There are 2 options here. We can enter immediately with a minimum risk-to-reward ratio of 1:5, or we can switch to the hourly time frame and check if there's a zone that can provide liquidity to the market. On the hourly chart, there's a bearish FVG, from half of which we can enter with a risk-to-reward ratio of 1:8, which is quite good. The price opens our position, but doesn't quite reach the target, and here's a very important point. If a break-even stop had been set after the price moved away from our positions, both positions would have closed at 0. But the essence is that if the price returns to the entry points, the idea is not yet invalidated, and break-even doesn't mean we won't lose money. On the contrary, we might lose good monetization opportunities, which is exactly what happens in the end. Our positions close in profit, 4.2 and 1.8. Note that we actually ignore the bullish rejection block twice in a row, and all simply because we're working according to the logic of order flow and zones of interest within them. It wouldn't have been possible to open a position for the 3rd time using similar logic because this fractal minimum was weekly, and in the context of it, the price confirmed volumes by forming an order block. Essentially, the same thing started, just in the opposite direction, but we'll talk about that some other time. Let's also consider an example of aggressive order flow and how positions can be opened within it. This is a gold chart on a 4-hour time frame, where we see that the price tested inefficiency and formed an impulsive bullish candle, followed by the formation of a zone of interest. We can switch to the hourly time frame and identify a high-resistance dealing range within which we are ready to work. But since we also have a fair value gap in the premium zone, we are interested in waiting for volume confirmation to open our positions for continuation. We see that the price tests the 4-hour FVG and confirms volume through the formation of an order block and another FVG inside it. From here, we can place our order. We set the stop loss behind the fractal minimum and the take profit according to your risk system. Let's say I'll set it at 1 to 3. Unfortunately, at the opening of the London session, the price closes our position at a loss and tests the zone of interest more deeply, after which it forms a new dealing range with an order block inside. This is also a point for us to open positions. Again, we set the stop loss behind the fractal minimum, and the take profit for me here will be standard, 1 to 3, to illustrate the logic of opening a position. Here the position closes essentially with one candle within an hour. We switch to 4 hours, and again observe a high resistance dealing range with inefficiency in the premium zone. On the hourly chart, the algorithm of actions is exactly the same. We wait for a test and volume confirmation. Here, the price already forms an order block zone and FVG inside at the opening of the London session, from where we enter a position. We get a very quick execution. We repeat the process once again. Again, on the 4-hour chart, we have a high resistance dealing range. Within the nearest inefficiency, we wait for volume confirmation on the hourly chart. We see exactly the same order block with inefficiency inside, and again we get a quick execution. On the 4-hour chart, the price again forms a dealing range, but we don't observe inefficiency in the premium zone. However, the price still continues its movement, forming another dealing range where there is a very small inefficiency zone. On the hourly chart, we get a quick test, rejection, and an order block zone, from where we can again place our buy order. The result is once again before your eyes. This is just one way to monetize this kind of movement. Here you can scale even further, say down to 5 minutes or 15 minutes, and enter positions from there. You can also work on the same time frame where the dealing range is forming. There are many options, but unfortunately, I can't fit everything into one video. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment.